Welcome to our investing tutorial channel, where we delve into the intricacies of financial markets and strategic investment decisions. In today's insightful episode, we unravel the mystery behind one of Warren Buffett's notable moves, the decision to sell Wells Fargo shares. Join us as we analyze the factors and considerations that led this legendary investor to part ways with a significant holding in one of the largest banks in the United States. Gain valuable insights into Buffett's mindset, investment philosophy, and the broader market dynamics that influenced this strategic move. Whether you're a seasoned investor or just starting on your financial journey, our comprehensive breakdown will provide you with a deeper understanding of the complexities involved in making such impactful decisions in the world of investing. In the interview, Warren Buffett provides an explanation for his sale of Wells Fargo shares. As you are aware, there were three grave errors, but there was one that dwarfed the others. Incentive systems are present in almost every business. There is nothing wrong with them, but you must be extremely selective about what you choose to reward. You cannot reward bad behavior, and if you do, you must have a mechanism in place to identify it. At Wells Fargo, for example, an incentive program was designed with cross-selling in mind, and amount of services per customer, which the business highlighted in each quarterly investor presentation. This made it clear that the organization's main focus was on this number, and it goes without saying that employees were paid, evaluated, and promoted in accordance with it. It turned out that the behavior that was encouraging was inappropriate, at least in part, based on that figure. We have committed comparable errors. Any business that designs a system is going to make some blunders, after all. But it's a mistake, and you will eventually learn about it. I'll explain how we found out, but the biggest error was that. I don't know, obviously, how the information got passed up the line at Wells Fargo, but eventually, if there is a serious issue, the CEO will learn about it. At that point, that's the crucial moment because the CEO needs to act in the Solomon situation that you witnessed in April 28th, the CEO of Solomon, I believe. The Solomon's president, the general counsel of Solomon, was sitting in a room when a man named John Merriweather came in and told them about some horrible and bad practices being carried out by a man named Paul Moore who worked for him. Paul Moore was filming the United States Treasury, which is a very stupid thing to do, and he was doing it partially out of spite because they didn't like him and they didn't like the Treasury. Thus, he made fraudulent offers for U.S. Treasury bonds and other assets. The CEO and the others realized on April 28th that something had gone very wrong and that they needed to report it to the Federal Reserve Board in New York or the Federal Reserve Bank of New York. The CEO's good friend, John, promised to do so, but he never did and probably put it off because it was a painful task. Later, on May 15th, another Treasury auction was held, and Paul Moore once again put in a lot of fake bets. And now, since high management was aware of it beforehand, and a man with pyromania had gone outside and started another fire, it's all over. And they had been warned that he was essentially a pyromaniac. After that, they lit it, and everything went wrong. It had to stop when the CEO found out. They then made a third mistake. But it was much less serious than the first two because they completely underestimated the consequences of what they had done once it was discovered. They were fined $185 million, and in the banking industry, people are fined billions and billions of dollars for mortgage practices and other offenses. The total penalties imposed on the major banks, I'm not sure how much it totals, minus 30, 40 billion, or whatever. But they assessed the severity of the issue based on the size of the fine, concluding that a $185 million fine indicated a less offensive practice than something involving $2 billion. They were completely mistaken in this assessment, but the main issue was that they did nothing when they discovered the problem. The system was already flawed enough. But they took no action. At Berkshire, the hotline is my primary source of information about anything that goes wrong at a subsidiary. We receive about 4,000 hotline reports or communications on the hotline each year, most of which are trivial. You know, like the guy next to me having bad breath or something. But there are a few serious ones, and Becky Amch, our head of internal audit, looks at all those people who come in anonymously, probably most of them and some of them. She makes reference to the companies, possibly the majority of them, but anything that seems serious, I will hear about, and that has prompted action. We have investigated some of those companies more than once, spending real money on special investigators when necessary, and as I mentioned earlier, it has turned up certain practices that the parent company would never tolerate. Overall, I think the system is working well, but it isn't perfect. I don't know what happened, but I'm sure Wells Fargo has an internal audit. They also probably have a hotline. I don't know the specifics, but I have to assume that a lot of communications were received about that. I also don't know how they routed them to the appropriate person or who was responsible at any given time. But that was a huge mistake if they were receiving communications and either ignored them or forwarded them to someone lower. As for Warren's business partner, Charlie Munger, he says, "You followed. What are your thoughts on it?" Well, put me down as skeptical when some law firm thinks they know how to fix something like this. Of course, you need a big compliance department. Every major wirehouse stock brokerage firm has one. And if we had one, we would have a big compliance department too, wouldn't we? Warren ABS, absolutely. If you're in a business where you have a whole lot of people under incentives, very likely to cause a lot of misbehavior. Though I believe we've had less trouble over the years by being more selective about who we choose to have power and cultivating a culture of trust, that doesn't mean that everyone should try to solve their problems with more and more compliance. Charlie says that an ounce of prevention is worth a pound of cure, and he understood that when Benjamin Franklin, who he worships, said, "An ounce of prevention is worth a pound of cure." Warren claimed, "An ounce of prevention is worth more than a pound of cure. But in my opinion, a pound of cure applied right away is worth a ton of cure that is postponed and causes issues to persist." Warren claims John's close friend said that the initial issue was what he referred to as a traffic ticket. He informed the Solomon troops that it was just that, a traffic ticket, and that it nearly brought down a business. Another CEO described the issue he had encountered as a footfall, and it caused the institution great harm. As such, you must act swiftly and candidly. There isn't a better method than hotlines and anonymous letters, in my opinion. I have received 3 or 4 anonymous letters in the last 6 or 7 years that have led to significant improvements, and while they are virtually always anonymous, they are also signed. But wouldn't matter because, obviously, if someone calls our attention to something that's wrong, there won't be any retaliation against them. However, I can tell you that even as we sit here, quite a few people are probably doing something wrong at Berkshire, and most of the time it's very limited. Even while it might just be small-time theft or whatever, you can see the potential harm when it comes to sales practices like the ones that occurred at Wells Fargo. Millions of fake savings and checking accounts were opened on behalf of Wells Fargo consumers without their knowledge or agreement, giving rise to the Wells Fargo cross-selling scandal. News of this fraud spread quickly in late 2016. The creation of these fake accounts continues to have legal, financial, and reputational ramifications for Wells Fargo after multiple regulatory bodies, including the Consumer Financial Protection Bureau, find that the company received a total of $185 million as a result of the illegal activity. The company faces additional civil and criminal suits reaching an estimated $2.7 billion by the end of 2018. Including, as recently as September 2023, former bank executives. This is one of the worst scandals in banking history, at least in the United States of America. They essentially underestimated the impact of the scandal, their stock, and their business in general. They paid a hefty fine, but it was nothing in comparison to the damage to Wells Fargo's reputation. And for good reason. Try to have all of that in mind when you're looking to buy in stocks of any kind. Warren Buffett essentially said Wells Fargo farewell. Warren Buffett, widely regarded as one of the most successful investors of all time, offers timeless advice on investing in stocks. He emphasizes the importance of a long-term perspective, urging investors to approach the stock market with the mindset of owning a piece of a business rather than speculating on short-term price movements. Buffett advocates for thoroughly understanding the companies in which one invests, focusing on businesses with enduring competitive advantages, strong management teams, and a consistent track record of financial performance. He often highlights the significance of economic moats, sustainable advantages that protect a company from competitors. Additionally, Buffett advises against attempting to time the market and instead encourages a patient, buy and hold approach. His famous quote, "Our favorite holding period is forever," encapsulates his belief in the power of compounding and the benefits of staying committed to high-quality businesses over the long haul. As we conclude our exploration into why Warren Buffett sold Wells Fargo shares, we hope this analysis has offered you valuable perspectives on the dynamic nature of investment strategies. Remember, the world of finance is ever evolving, and learning from the experiences of seasoned investors like Buffett can serve as a guide on your own investment journey. Stay tuned for more insightful tutorials on our channel, where we continue to demystify the intricacies of the financial markets and empower you to make informed decisions. If you found this content valuable, don't forget to like, share, and subscribe for future updates. Happy investing!